Okay, we're now working on exercise 1115. We have 3 transactions. On May 1st, we're going to purchase equipment using a note payable. And then on December 31st, we have to accrue interest. That means we have to record the interest that's owed at the end of the year. And then on May 1st, a year later, we're going to pay the note plus the interest. So let's work with the original transaction. On May 1st, we purchased equipment, so we're getting equipment. Equipment, of course, is an asset, and the asset is going up, therefore it is the debit, and we have to show debits before credits. $12,000. And the note payable is a liability, and it is increasing on the credit side. We have more debt. So we purchased equipment in exchange for a 1-year 3% note. Okay, it is now December 31st. So we have to accrue the interest on the note payable. Accrued, remember, means something has accumulated but not yet been paid. In this case, the interest has accumulated, but we've not yet paid it. Remember, we're not going to pay the interest until May 1st of the next year. So we have to figure out how many months have gone by from May 1st to the end of December. We've got the full month of May, and then June, July, August, September, October, November, December. That's 8 months. So the formula for our simple interest is principal times rate times time. And from May 1st to December 31st, that's 8 months. So it's $12,000 times 3% times 8 divided by 12. And that gives us $240 of interest expense. Now this interest expense is increasing, and as you remember, expenses increase with a debit. And the other account is interest payable, because remember, we're not paying the interest yet, therefore we owe it. So this is called accruing interest expense at year end. Okay, now it is a year later. We're going to pay off this note plus the interest. So when we pay off this note, this interest payable has to go away. How do we make a liability go away? We have to decrease it. So that is going to be a debit. Interest payable, debit, $240. Let me scroll back up to the original transaction. We know since we're paying off this note, we have to get rid of that note. So we're going to debit the note to get rid of it. And we also have to record interest from the end of the year to the beginning of May. So we have to record interest for January, February, March, and April. That's 4 months. So here's our calculation right here for the interest from January 1st to May 1st. $12,000 times 3% times 4 divided by 12. That gives us $120 of interest expense. Now the final part of this transaction is we have to pay cash. Well, how much cash do we have to pay? Well, we have to pay back the original $12,000 plus 3% for a year. So it's $12,000 plus 3% of $12,000. So the calculation for that, for the cash payment, is $12,000 principal plus $12,000 times 3%. And that should be $12,360. You should do this check separate from just adding these up, because you might have made a mistake on these. And now to double check our work, we should add these 3 up to see if they equal 12,360, and they do. Paid note and interest at maturity.